Hey guys, welcome back to the video. I'm Luke, a CFA Charterholder, and in today's video we're going to run through some of the examples of principal-agent conflicts that can arise in a company scenario. Principal-agent conflict, as I've discussed in previous videos in this series, is a conflict that arises between the shareholders and the managers of a company, and it involves managers not acting in the best interests of their shareholders, prioritising objectives that further their own interests but do not align with the primary objective of owners in the company, which is to maximise company value and therefore maximise shareholder value. But yeah, let's get into it and discuss further. Okay, so a very quick recap of what the principal-agent conflict is. I've gone through this in detail in another video, so please feel free to check that out. But when managers of a company are appointed by the shareholders, so the shareholders are obviously the owners in the business, and they appoint a board of directors who are legally compelled through a contractual relationship to act in the best interests of the shareholders. So shareholders want to maximize firm value, to maximize their financial return, so the board of directors must always act with that objective front of mind. However, in some scenarios, which we'll run through in this video, managers can prioritize their own interests to the detriment of the interests of the shareholders. So sometimes they don't act in the best interest of the shareholders and take actions which does not increase shareholder value or is actually detrimental to firm value. This creates a principal-agent conflict. And this conflict arises because agents often hold more information than the principal. This is known as information asymmetry, and this exists within pretty much every large company because managers are involved in the day-to-day running of a company. They know much more about it. They know more about its risks, its future outlook, its competitive dynamics than the shareholders, because shareholders are just not involved in the day-to-day running of a company. That's the role that they delegate out to managers. But this information disparity means that the agent can take actions that work in the best interest of the shareholder without the shareholder even knowing they're doing so. So a successful shareholder-manager relationship or successful principal-agent relationship has to be built upon deep trust, going in both directions. The shareholders need to trust the managers that they're hiring implicitly. So how can principal-agent conflicts arise between shareholders and managers? So we're going to run through 5 examples, and I think these 5 examples are worth knowing before going into the exam. I've gone through each of them in detail and we'll discuss them in this video. So first up, we have insufficient effort. So when managers are appointed to steward the company, there's an expectation that they have the relevant skill and will put in the relevant effort to do so. However, that's not always the case. So managers may lack the skill and expertise needed for the role, or they just may not apply enough effort to adequately steward the company and to generate an uplift in shareholder value. So managers may be happy to collect their base salary, but will do minimal work to take the company forward in a positive direction. They're happy to maintain the status quo, but don't want to go above and beyond to increase the value of the company. So they're unwilling to make risky investments, keep costs down, so they allow the cost base to rise to a high level, and they fail to make difficult decisions such as shutting down unprofitable divisions or making redundancies. They fail to monitor employees and fail to assert an adequate level of control over the firm. There's also a scenario where senior managers fail to allocate enough time to their role of managing this company because they're involved in other things like political activities or charities, overseeing personal investments, or serving as directors on other boards, which take priority. It's not uncommon for CEOs of companies to be independent directors on other boards too, and obviously be involved in charitable activities. They've obviously got personal wealth that they're looking to manage and grow. So if a director is spread too thin and they're failing to allocate enough time to their role as CEO of the company, that can create quite a large conflict with the owners because they're not putting in the effort and time that's required to fulfill their objectives. Second up, we've got managers having inappropriate levels of risk appetite. So when you think about remuneration packages for senior executives, they often include stock options. And stock options are included because, in theory, they align the interests of managers and shareholders, because obviously stock options will increase in value once company value increases above a certain level, and obviously shareholders want to see company value increase too. However, the problem with stock options is that they can lead to managers taking excessive risk, because option holders really only benefit if there's large increases in the share price above the strike price. They're completely protected on the downside. So if the company underperforms, then the managers don't lose out because they've got call options in the company and they're protected on the downside, because if the share price falls, they won't exercise their call option. They're not penalised at all if there's a large fall in the share price, whereas obviously shareholders have a different payoff. They have unlimited downside. Shareholders benefit if company value increases, but they also lose out if company value falls, whereas managers aren't subject to the same payoff. You think about how a call option works. That's the payoff to company managers, whereas shareholders face downside if the value falls, whereas there's no downside for managers. So this can lead to managers taking excessive risks with company money. Conversely, managers that receive no stock in their compensation packages and instead just receive an all-cash remuneration package tend to be significantly risk averse. Shareholders obviously want managers to take some risk, because without risk you don't earn any return. So shareholders want managers to take calculated risks to try and maximise shareholder value. But if managers are compensated only with cash, they're not going to want to take any risk at all. They want to minimise risk because there's no upside for them of the share price in the company rising, and they don't want to lose their job because it's their only source of income. So if managers are compensated with cash only, they don't see any of the upside potential because they've got no stock in the firm. They've not got any stock in their remuneration package. So there's no benefit of them of taking on any risk at all. They'd rather minimise risk to ensure that they receive their cash-based salary and bonus every year because they don't want to lose their job. Investors have diversified stock portfolios with many companies comprised within them. So they're happy for managers to take higher risk with one company, because in a diversified portfolio you can afford one company to underperform. If you're an investor and you've got 100 stocks in your portfolio and one company fails, it's not the end of the world. However, managers only have one job, which if they lose can be super detrimental to their lives, their families' lives. So shareholders have considerably higher risk tolerance than managers, and this is what's creating the conflict, the imbalance in risk tolerances between the shareholders and the managers. Third, empire building. So some companies will link management compensation to the overall size of the company. So managers may be rewarded for increasing total revenue. So that's one way that managers are incentivized to empire build or increase the number of employees. So these two metrics are examples of metrics where managers can pursue higher revenue, they can pursue a larger employee base, but that's not necessarily going to translate to higher profit or higher shareholder value. Just because you pursue growth doesn't mean you're going to be pursuing profitable growth. You could be investing in projects which brings in incremental revenue, but if it's not profitable, then it will be detrimental to shareholder value. So revenue could be added, which would suit the managers because they're remunerated in line with revenue levels. But if profits decline as a result, this would not lead to any shareholder value being created. And this is where creating alignment through remuneration structures is incredibly important for the executives. So managers motivated by company size related compensation structures often pursue acquisitions that may increase revenue but are not profitable, therefore can be detrimental to shareholder value. So again, it's a misalignment when it comes to remuneration structures. You need to make sure, if you're a shareholder, that company managers are incentivized in an appropriate manner such that they're not pursuing growth that's not profitable. You need profit to increase shareholder value. If you're just incentivizing managers to increase the number of employees or increase total revenue, then that could actually have a negative impact on the financial return of the shareholders. Fourth, we've got entrenchment. So managers who are concerned about losing their jobs, and obviously that is a concern for managers because they've only got one job, often only one source of income. They will look to protect their job, often by copying the strategy of competitors and pursuing transactions which are complicated but uniquely suited to their skill set. So they'll often pursue projects, restructuring transactions, which may not increase shareholder value, but they may be uniquely suited to execute them. So to make it look like they're doing a good job, they pursue strategies which have no benefit to shareholders. So they want to look like they're doing a great job, but really, if you sort of dig under the surface, these are things that managers will pursue to just make themselves look better and pursue higher compensation as a result. So managers who are concerned about job loss often avoid investing in risky projects as they want to avoid the risk of bankruptcy and protect their employment. We touched upon this a moment ago. Managers have one job, one source of income, so they often are more risk averse than shareholders because shareholders hold a diversified portfolio of stocks and they can afford for one company to underperform, whereas managers aren't so lucky. And the board may avoid speaking out about the management team, even if it's in the best interests of the shareholders. So fifth and finally, self-dealing. So this is where managers take the companies and the shareholders' checkbook and go a bit crazy. So executive spending on personal benefits, such as private jets, lavish offices, expensive lunches, are a clear conflict because you're going to reduce company profit, which at the end of the day belongs to shareholders. You're putting more costs through for the benefit of yourself. If you're a CEO or CFO, then that's a form of defrauding investors because you're misappropriating company money. At the end of the day, company money is shareholder money, and if you're spending it on things that aren't necessary or aren't needed to increase shareholder value, then that's a misuse of shareholder funds for personal use and gain. And one way to kind of think about preventing managers from spending excessive amount of money on personal benefits is by increasing the manager's personal ownership stake in the company. Because what we tend to see in practice is the smaller the amount of ownership senior managers have in the company, the less they really think about these costs because they're not really bearing them themselves. At the end of the day, if you're a manager and you're a material shareholder in the company you manage, then you, as a byproduct, will be bearing the costs that you are incurring. You'll be more interested in maximising firm value and less likely to misappropriate assets. So yeah, a good way to address the self-dealing conflict is to increase the manager's stock-based compensation. So cool, that's everything I wanted to discuss in this section. So principal-agent conflicts are a key area of the corporate issuers section of the material. It's worth knowing all of those 5 different ways in which manager-shareholder relationships can be complicated. You know, issues such as self-dealing, entrenchment, empire building are all common ways that we still see in practice today where managers will pursue objectives which don't align with the primary objective of maximising shareholder value. So yeah, that's everything I wanted to discuss. Any questions, feel free to fire them off in the comments, and I'll see you guys in the next video.